Good morning, good afternoon, good evening, one and all. This is the Smoking Barrel. I'm Rustin Edwards, based in Switzerland, with the illustrious traveling co-host, Mr. Matt Stanley, in beautiful Dubai. What's going
Hello,
on, man?
hello. Well, back from Southeast Asia. Very nice time. Some good meetings and good times were had. Spoils were shared. But yeah, back to the. It's very humid today. It's one of those days that people, when they go, "Oh God, mate, doesn't it get really hot in the summer?" It does. Today is one of those days. It's about 38 with about, I'd say, a heat index bringing it closer to 50. So yeah, happy days, mate. Happy
100%
days.
humidity.
Yeah, exactly. But and no one thinks in the desert it gets humid, but it does. I live about 2 miles from the coast. It does get humid here. Anyway, I've got air conditioning. It's all fine.
Yeah, in the deep south, they call that it's a sultry day. A sultry day.
Sultry. Yeah, yeah. But he's one of those. That's what we call it. Something different in my house. But yeah. Anyway, yeah. Hope everyone's well. It's been 3 weeks since we were on. Let's see what's happening with Brent in that last. We were 3 weeks ago, 1st of July. Brent was trading at $69.11. Where are we now?
Oh.
$68.97.
You can just put brackets around the Brent price at this point.
Yes, but you can, but I mean that's okay. I mean, it was one of the talking points that we had, well, many people had last week because there's been a lot going on, which I know we're going to talk about the next the next EU sanctions package on Russia, what it means for oil, but largely apart from the blip that was the 12-day war, Brent has largely been pretty range bound for Q2.
It has been for the most part. I mean, if you look back in the history, we had a low of close to $60 on the front month contract, or just below $60, and we're right now right around 69. So we've been in a 10-day, $10 range from, let's just call it end of March till today. So it hasn't been that dynamic in the trading platforms. Structure is still, I'd say relatively strongly backwardated, although the backwardation has been coming out, albeit very slowly. It's been dropping over the last couple of weeks, and I think that's just a case of, where's the global economy versus the glut of supply that's being tanted about, but I don't think it's become apparent just yet.
Well, I wanted your opinion because obviously the Kepler House view I always agree with. Always agree with. And I wanted your view. This was the 2nd of July.
So we're looking for a bit of
2nd of,
constructive criticism, are we?
no, 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 no. That's why I'm asking you the questions. No, look, I mean, here's our house view. If I can share my screen, Mr. Edwards, I will show you exactly what we're talking about. So, where are we? 24th of July. Everyone's getting ready to go on holiday if they're not already. And I hope you're all listening to this whilst you're on holiday because you're a committed bunch. Like, comment, subscribe. But yeah, look, I mean, the so far this year, it has been one where the market has sold into a geopolitical spike, i.e., 12-day war. Yes, it rallied, but on that Monday when the Donald came out after the bombings we saw ex Iran onto a US Air Force base in Qatar, the market sold off heavily. The market was a little bit shocked. We came out with a podcast on a Sunday. Where's Brent going to go? It ended up puking. And, that has long been, the long trade has always been sort of buy into geopolitical strife. It's the opposite this year. And the other when it comes to supply. OPEC have bought back 1.5 million barrels a day so far of the 2.2 million of voluntary cuts. That has been welcomed by the market. Now, when it comes to people buying that oil that are bringing back, the Middle East buys and burns a lot of that crude oil and or historically fuel oil over the summer for power generation season because, like I said earlier, it is so freaking hot. It isn't a season. It is a seasonal thing. It's not. It's not an uncommon thing. It always gets hot in the summer. That is just the way it works. So when it's going to Q4, that demand drops off. This is my question to you. That crude oil that is being burned directly by the Saudis, and we see that oil back in the market. Our view is very bearish. that before I ask the question, because this is, the potential supply and demand balances don't lie. You can see this, right? Yeah.
Yep.
Okay, look, this is dated Brent, right? Dated Brent price forecast, and historically, sorry, I'm getting overexcited. Over the last 3 years, our dated Brent price forecast has been the most accurate of any forecast. We've come in pretty much spot on. Let me just zoom in on this for a moment for you, so you can see it. So look, this is our forecast now. This is our forecast for the month prior. You can see we're up here now, roughly, right? Dated Brent, the DFL, the dated to front line is around 40 cents right now for Q4. So we're roughly where we are now. 52 October. I mean, I get that there is going to be downward pressure on Brent. We cover that here. Um, we see a 14 to $15 decline from Q3 versus Q4. I mean, I get the logic. I get the logic. We're pricing now Q4 on futures around $67.50 a barrel. Do you think that supply shock will be priced in so dramatically by the market? Do you agree with the fundamentals there?
Well, I think that, to get that type of price reaction, you have to actually start seeing inventory stocks build
Okay.
in areas. I mean, I think if you look at China, China's been taking in a lot of inventory. The refinery runs are not moving up, so they've been building stocks inside their storage. And the only way you get the price action to come down is that you have to have that activity curtailed to where they're no longer buying excess oil. So then you start building surplus in other locations. So, we haven't seen a point where the market is going to build inventories per se outside of strategic stocks because the market structure is still heavily backwardated and nobody wants to roll 1 million barrels of storage with a 70 cent backwardation.
Right.
Um, so you have to see that kind of activity where your strategic storage buying comes to an end or slows down dramatically in order for that to start creating a backfill into the general market in itself. And I think the key point to watch there is, how much oil do you have sitting on the water? That's going to be probably your first flag indicator that stocks are starting to build. So until you start seeing
Yeah.
that, I
Yeah, I
don't
think
see
you're right. I mean,
reacting yet.
yeah,
Now, the interesting part of what you said earlier about the
yeah.
utility burn in Saudi Arabia,
Sorry.
if they come back again at the next OPEC meeting and release the balance of the voluntary cuts, that's going to be roughly about a year ahead of what they originally scheduled. Do they start dipping
Yeah,
into the non-voluntary cuts and start allowing production to go up to the quotas again?
yeah. Yeah, look, I think you're right. I mean, I think that is, if there is leverage, I would argue that OPEC have it. And what would the market reaction be? Because largely the next OPEC meeting's on the 3rd of August, right? And that will be for
Yes.
September, for when it comes back in September. And that will largely be, that will align actually with all the voluntary cuts being back onto the market. They're at a flat base. There's still the compensatory cuts that I'm sure Amina, my colleague, will cover, our resident head of OPEC Plus, an expert on that field. That ties in nicely for APEC, right? Let's go back to just quick, just before, just staying on where price forecasts are going, but it's also a demand story, right? Let's touch on the demand side of that. Last year, APEC market sold off aggressively on the first day because what was this sort of acknowledgement of plateauing Chinese demand, right? That was sort of pricing, and the markets came off heavily. I think I'll pull it up, but the markets came off heavily that time. So OPEC is kind of going into that week, whether that is
And
intentional
that
or
was,
not.
if you remember, that was a realization by the market that yes, it's true. China's demand is slowing down. I mean, we were calling that here on this illustrious podcast months prior that China's demand looks very
Yeah,
weak. It looks very weak. It's being overstated, and it was kind of
yeah,
like the market woke up to the fact, that first day of APEC with people, having face-to-face meetings, going, "Oh crap, it really is slow in China."
yeah,
And so it was a wake up call. It was like, here's your cup of coffee, sir. Enjoy. Open those
yeah.
eyes.
That's right. Because on the 29th of August last year, Brent was trading at $80.78 a barrel. And then you go to the end of APEC, let's say, can't remember when it was. I think it began the 9th. And Brent went down to a low of $68.68. So we're down $13 in 10 days with an acknowledgement that you're right, that Chinese demand is plateauing. I mean, going back to the price forecast uh, um, for a moment, Q4. Look, it's always difficult, isn't it, to forecast? You know, the old adage, you know, if you're going to forecast often. Um, Oil markets have surprised a lot of people so far this year. They've been remarkably resilient. I know oil markets are very good at pricing in and pricing out geopolitical risk with, you know, the Israel-Iran conflict, you know, what's happening with, you know, other geopolitical issues, saying in the Eastern Med. But oil markets have largely shrugged off quite a lot and remained range bound for that very reason. I don't know. And I just, in my opinion, right? Sorry, Kepler people, love you dearly. I just can't see the market reacting over the next 6 weeks coming into Q4. I just can't see a $15 puke in flat price. I just can't see it.
Again, I think it only can happen if you get an actual curtailment of buying activity for strategic stocks. If you start seeing that action, you start seeing ships starting to build up on the water, floating inventory starting to build up. Yeah, there will be a price collapse in the market because it's like, okay, contango's coming. So you have to get the backwardation to get out of the market in order to flatten the curve. And then you have to get it to go into a carry market.
Yeah.
Now, the um, idea that a contango could develop is a bit surreal when you have so much action in the front end of the curve, basically trying to keep a premium in the market for geopolitical risk. Because yes, Iran, Israel, it's a ceasefire or whatever you want to call it. So it's not a peace, it's not a stop of hostilities. You still have the Houthis attacking ships in the Red Sea.
Yeah.
Um, you still have you have the new EU sanctions on Russia, excuse me, trying to get all these sanctions regime in my head squared away, which will have could have a dramatic impact. It's already starting to impact the Nira refinery in India. Um, and so, these things will keep crude on a supportive basis in the front because, as any type of trader would say, is that you can't sell the front because something could happen tomorrow, which
Yeah.
would rally the markets $10
I mean,
potentially.
I think I tell you what's what has been what has been resilient, right? And I'm not saying it started great, but we had a oil product demand growth for 2025 of about 700,000 barrels a day. We now probably think it'd be a touch higher, maybe between 750 and 800, something like that. And largely, demand has surprised to the upside this year. I mean, you look at refining margins, the gas oil crack's doing very well. You know, diesel margins are really keeping the barrel, keeping the whole barrel, the whole oil complex supported. You know, the 3-2-1 crack right now is trading $28 a barrel. That's a healthy margin, right? I mean, I don't know. Look, I mean, I think the first half of the year, we're going to do a review of the first half of the year. We're still waiting for some data to come in, and then we'll have a look at what the first half looked like, which I think is it performing better than a lot of pessimistic forecasts, right? And so, is that a
Well,
good
I mean,
thing? Bad thing? Right,
the,
discuss, right?
but the demand side, I think it's a story of heavy sour versus light sweet.
Right,
Because when you look at what products have been performing very well so far this year, gas oil, high sulfur fuel oil. What products have been performing pretty poorly? Naphtha, gasoline, VLSFO.
right.
Um, so when you start thinking of your split between heavy sour and light sweet, the heavy sour spectrum has been the more supportive side of the equation, which helps drive these higher cracks that you see on the 3-2-1 because the resid cut, the cracks on the resid market have been relatively strong this entire year in the upper single digits. Uh, yes, it's a negative crack, but when you're -2 versus a historical crack of -15, that's a pretty strong margin to look at. And
Yeah,
you couple the diesel market with the fact that you've had, a lot of, the big hurdle of diesel has been, stocks are low. So we've heard this bugaboo before. Stocks are low. You've had refineries shut down. I mean, so now the Prax refinery in the UK is now shut down. So that just adds less production capacity and a more physical demand profile because, yeah, the Prax refinery, 116,000 barrels a day plant,
Yeah,
produced diesel, gas oil, jet fuel for the UK market. That's gone. And so if you lose that one, you lost Grangemouth. You just have more demand with less refining capacity available to meet that demand. So that brings the cracks into a supportive market.
yeah.
And diesel is still a predominant fuel in Europe. Therefore, without this refining capacity, which has been shut down because it wasn't profitable, other refineries can benefit. But you do
But
create these tight markets because you don't have the supply.
just elaborate on for the uninitiated. You mentioned the heavy sour versus the light sweet barrel there. What's behind that in your eye? Why is the what's happened to the heavy sour barrel?
Well, the heavy sour barrel, I mean, who produces heavy sour crude? Russia, Venezuela, Iran. What's the common denominator amongst those three major producers of heavy sour oil? They're all under some type of sanctions regime.
Right.
So if those barrels are not commercially available in the market, then you really don't have them in to help support the heavy sour side of the crude. Those crudes produced a lot of high sulfur fuel oil and a lot of gas oil.
Yeah.
Uh, so if those barrels are not commercially available, it puts an upward bias on the heavy sour side of the curve.
Okay. Yeah. Thanks for that.
And
I
now,
just think I just think it's really important to clarify that because I put in my commentary this morning that even though we're in a state this current state of affairs in oil markets is largely benign in terms of activity, range bound. We've spoke about that majority of the year, apart from the odd grey swan event. It's not a black swan really, when we've seen unfortunate geopolitical conflict spike. But let's talk about, going on from that, where you mentioned about sanctions and what it means for supply, what it means for market. So, main takeaway out of Singapore last week across the whole supply chain, owners that I met, agents that I met, traders that I met, NOCs that I met, national oil companies that I met. What's the kind of view on what's going to happen about the latest EU sanctions package that came out last Friday regarding Russian crude, Russian products, right? So let me just show you this because it's a really good breakdown timeline because this is really what's key. Unfortunately, when it comes to these kind of government or bloc-led initiatives, when it comes to sanctions, they're like 800 bloody pages. So you got to rive through them all. What does it mean? Who's allowed? What does it mean documentation-wise? Fortunately, my colleague Zamir has done that for us. So we shall break it down. Right, here we go. Key dates. 15th of July, start of the 22-week monitoring period for calculating the first dynamic Russian crude price cap. 20th of July, this is when the regulation was enforced. So that's when essentially the sanctions that were announced last week come into force. Now, 3rd of September, here's a real kicker. Not the most important part, we'll get onto that in a moment. A new crude oil price cap of $47.60 comes into effect on the 3rd of September. Right. What's the current price cap of crude? 65,
uh,
right?
60.
60. So this has been dropped by $13 a barrel. And
Now, a point of clarification here. This is an EU price cap. It is not a global price cap. It's not the G7 price cap. So this is only effective for EU based transactions organizations. The United States did not sign off on this.
right.
Neither
Well,
did, as far as I understand, neither did Japan and neither did Canada.
okay. But what
So
what is
just a
so
point
with
of
the
clarification
huh?
there. That's just a point of clarification on this price cap. So now we're creating a regime in the world where we have multiple price caps.
Okay. That's important. Sorry, it does say $60 a barrel here. Read your article, Stanley. Is there a price cap in force in other parts of the world?
So the United States has one.
Which is?
So let's just the G7 had a price cap of $60.
Okay.
And the other price cap for distillates and one for negative crude prices, negative crude barrels, or negative margin, or negative crack barrels. So yeah, there is a G7 price cap. Now this is an EU price cap.
Okay. Okay. Right. Let's get onto that in a minute, right? But the new price cap comes into effect 3rd of September and there's a 45-day transitional period for pre-existing contracts. Okay. So that ends on the 18th of October. So I'm assuming anything that loads between now and the 18th is subject to $60 a barrel price caps. After that, it
Well,
goes down to
actually,
47.60.
if you read the statement there, a 45-day transitional period begins for pre-existing compliant contracts concluded before the 20th of July.
Right. Okay. So this is, but this, so before last week, anything that been concluded for loading between now and the 18th of October, anything after that, when it loads, not concluded before the 20th of July, that's breaches the sanctions. Okay. Clear as crystal. Right. So that's when it's, but here's the biggest part for us, right? This is really what we're going to talk about. The EU have banned from the 21st of January no imports of refined products made from Russian crude, even if refined in third party countries. So basically, that means if we're looking at the people who are importing crude oil now, and there was an article about this on Bloomberg yesterday, something actually I raised on Monday when I was in a meeting. If you're looking at the big refiners who are purchasing Russian crude oil now, a lot of the Indian refiners are. I'm not singling out India here, but you mentioned earlier on, this is specific countries, specific blocks getting together and sanctioning. It's not a global sanction, right? There is I don't think anyone's part of a global sanction. But obviously, if you want to do business in the EU or business in the US, breach those regulations at your peril, right? This though is a big move because we can talk about enforcement and transparency and traceability, and I'm sure everyone will between now and Q1 next year. But this is a significant move. So if say if Reliance purchase Urals crude oil in Q4, even under the price cap, they are not allowed to refine that and then sell the diesel that yields from that crude oil and sell it back into Europe, right?
That's how I would read that. So I would say that this not only impacts India, it also impacts Turkey.
Yes, yes. But Turkey are not refining Russian crude oil. It just happens to
Well,
be that's been
I,
quite
I
significant.
would say that they probably say they don't, but they probably do. But that's
That's your
neither
opinion, Edwards. That's your opinion, not
that's
mine. Okay. Um, but look, I mean, this this is for me. I know we're in a state of muted activity, what's going on. But for me, this is probably the most significant step the EU have made when it comes to sanctions enforcement of Russian energy. This is
Well,
really turning the
and
screw.
let's just say there are some other caveats in here as well.
Okay.
The other caveat being that if you're a net exporter of oil and you're bringing in Russian products, you're exempted from all this.
Hang on.
So, for instance, if you're a Saudi Arabia who happens to bring in a lot of Russian fuel oil to run through your power plants and you export fuel oil, that's okay. If you bring in Russian gas oil and you put that into your local market and you export your own produced gas oil, that's okay.
But if you import Russian crude oil and then sell that crude oil refined products into Europe, that's not okay.
That is okay as long as you're a net exporter of products. There's a bit of a caveat in all that.
Are you really? I mean, okay, that's really interesting because so this is okay. That's interesting. So these sanctions then are specifically targeting the people who have been doing it previously because India are a net importer, right?
Correct.
Same as Turkey,
Yes.
China, right? China, yeah, as well.
And China. Exactly.
Okay, okay. What about okay? Yeah, fine. So okay, what about this? Right. So let's say I didn't know that. That's very interesting. Okay. Why would you say why have they put that caveat in place?
Because basically they don't want to. The way I would read that is that again, Saudi Arabia, ADNOC, export a lot of product and a lot of crude oil. Of course, they don't want to siphon off those streams to fall under the sanction regimes because they're bringing in Russian products into their countries.
Hang on. So it's a hedge to make sure that diesel prices in Europe don't get too overly inflated.
That's how I would look at it. And the other thing about this is that certain countries are already given an exemption, i.e., any product coming from the United States, Canada, Brazil, I believe Brazil. I have to look that up. We're given a complete, you're fine. You don't have to worry. No
Really?
need for documentation. As long as the origin's out of these certain countries, you're clear.
So it's a sort of benign swipe at those who have taken advantage of bypassing sanctions, circumventing sanctions, and then just prop because essentially, okay, this is really interesting because if the feedstock cost of now hang on, right, so if India continue to buy Urals, um, do, the contract price they buy at, sorry, I'm sort of confusing myself here. The new price cap will be $47.60 for Brent. Is that the level that India would essentially buy the material at? Or, but
Well,
the
that has to be, that's the FOB price, right?
yeah, but why would India have to abide by the price cap set by the EU when it's nothing to do with how they're buying their oil? So how would they profit from that price cap?
Well, basically, if Russia, if everything was done on the up and up, they'd be buying crude oil at $46 a barrel if the market was $70 a barrel. So you're buying crude that's fully super discounted versus the market value, bringing it in, refining it, creating, if the crack is $20 on gas oil, well, guess what? You've just made
Yeah,
$20 plus 20.
but I get exactly that's where I was going with that. But if they're using, say, a Marshall Islands flag tanker, nothing to do. All the infrastructure around how they're going to do it and ship it and insure it is nothing to do with Europe, and it's loading out of Russia. Why would the EU price cap come into play? I don't understand. How would that? Why would that be enforced on the contract between, say, a Reliance and, say, Rosneft?
Well, because again, you're not an entity. You're buying crude outside of where the price cap is. Therefore, you become afoul of the new EU sanction.
Right. So you're protecting your interest to maintain doing business in Europe.
Well, you're basically trying to force the buyers of Russian crude to stop buying Russian crude. And so you make it financially infeasible for them to buy Russian crude, i.e., the Naira refinery has to export or sell to the local market. Well, the local market has told Naira, hey, we're full. We don't need your product. You've had two major oil companies, PetroChina and BP, cancel loadings out of the Naira refinery
Yeah.
so far. So you basically are going to bottleneck that refinery where it can no longer operate because you're basically going to become infeasible. And so you have to change what crude slate you buy.
Okay. I get that. Yeah, I get it. Thanks, but I suppose I'm just trying to work out if all you're doing is if the feedstock cost is cheaper, as you must say, but the price of where say you're pricing your gas or crack off an EU number, that isn't moving. Right now, that's around $95 a barrel, right? For August ice gas oil, essentially. Your feedstock is $47 a barrel.
Yep.
Your August crack, I know it's different because you're talking about different months, is essentially like $45 a barrel, right?
Yes.
But how do you benefit? How would Reliance benefit if they don't have to get
Well,
EU involved? I
so
suppose.
again, this is only EU destination product, right?
Yeah, yeah.
So what stops Reliance from selling that diesel into South Africa or into Nigeria
Nothing.
or into Kenya or Indonesia or Malaysia?
Yeah, I mean, it benefits India GDP as a net importer, and Barney has Reliance.
Well,
That's a
it
Bloomberg
benefits them
article
up to a
yesterday.
point because at a point, you got to find markets that will accept that oil. Now, if you've got banking relationships with European banks, because it's not only that, the whole thing around the provision, associated services are also part of this provision. So technical assistance, brokering, financing, insurance, reinsurance, transportation.
Yeah.
So it basically says that you, as a Reliance running Russian oil, creating gas oil, which you want to sell to the outside market, you can't use a European shipping company, European flag tanker. You can't use European insurance, finances, brokerage. Voila.
Yeah, yeah. That all that infrastructure around you disappears. Okay,
Yes.
I get it. It's going to be, but surely, if you're looking at it from a crude supply and demand balance point of view, okay, I know demand wanes over the summer in Europe, but if you're talking about a real enforcement, much stricter enforcement of Russia being able to sell their oil, that's, I mean, positive Q4, right? In terms of what all
Well,
markets should
I,
stay
I,
supported.
I I always like to come back to my quote from Jeff
Oil will
Goldblum,
find a way.
classic oil will find a way.
Yeah, I agree. It's just people have
Because
got
when
to
you
get a
think
lot
of it,
more inventive.
so let's look at the timing here. We're in July. These regulations don't come into full force on the export product until January 26th of next year.
Yeah,
So that gives people plenty of time to do the winter fill, buy whatever oil they can get their hands on, get into EU stockpiles, and go through the winter of 2025, 2026.
so you're
What
saying
it also
buy Q4 gas oil cracks.
what it also gives the market the ability to do to rebalance. Because, for instance, if your net importer regions of gas oil in South America and Africa are buying product from a European or a US based refinery, and now you've got these Indian refineries that have to find alternative markets outside the EU for their product. And so they can easily displace those exports out of the United States or out of the EU, thus causing that to backfill into those markets and
Right,
keeps the markets in balance.
right. So it's just a change in trade flow, like we saw 2023 when,
Yes,
50% of Russia EU's diesel came from Russia, then it suddenly went into Latin America, and then Europe was supplied by the Gulf Coast because that arb down into South America closed. So it's just an extension of that. It's just a change in trade patterns.
you're just going to change it. So the big winner in this is going to be freight once
Right,
again.
right. That was my next question. I want to show you something that my freight analyst put together as well, which was on tanker supply. Let me just conscious of time. Let me share this with you. For the tank, you can see this. Okay, this is for the tanker markets. Look, this is really important. Okay, Russian crude cargo loads by Greek-owned tankers. This is our data. This is public data as well. We're just very good at aggregating it. Okay, tell me about this. If you've got a Greek-owned tanker, Russian crude, surely the enforcement applies to these guys, right? So how does that work?
Well, I mean, it puts more pressure on Russia to get crude out, theoretically. But the tanker's Greek owned. Okay, they transfer it to a Dubai company, and voila.
Right. Okay. Yeah, sure. I mean, look, it's always been a myriad of ambiguity, hasn't it, when it comes to UBO, ultimate beneficial ownership of vessels. But I think that's the one to watch for me. I think gas oil will be the leader on the energy complex coming into Q4 on the back of this, and crude will follow. But I think it's how it gets shipped. Does the grey fleet expand? Does ownership and uh, domiciliation continue to change as well? I think this is going to dominate as we come into APEC early September this year. I think this is going to dominate conversation. I really do. I think that, I mentioned earlier on that the acknowledgement of Chinese oil demand plateauing, even though they still buy a shit ton of crude oil. I think this year the conversation switches to supply and how people will become, I don't want to say inventive, but how those sort of what have been the swing refiners now in West Coast India and the AG and China, how people pivot because Europe still needs the oil. So I think that's going to be key. And I think that's why you look at Q4 structure on gas oil and it's very well supported. And I think that will continue.
Sure. I mean, because that is where your pinch point sits.
Yeah.
I mean, the one thing that, when I read through the EU sanctions when it comes to crude oil transfers, it doesn't necessarily say anything about prohibiting the use of European ships on crude oil movements. It's on products.
Right.
So there may not be any real hindrance to Greek-owned tankers lifting Russian crude still, but transporting Russian refined product from a refinery back to the EU, yes, there's a problem with that.
It's funny because just before we go, I read a really interesting article the other day. I can't remember where I saw it, but how well the Greek economy is performing. And listen, 10 years ago, with all respect, the Greek economy was in a state of, I don't know when it was, a state of crisis, constant bailouts from the EU. Now it's one of the most stable. Shipping and the whole supply chain around shipping being a significant contributor to GDP within the country, that it's doing well on the back of how to circumvent sanctions.
It's a bit of an interesting, flipping of the script, as the worm turns, because in 2013, 2014, you had, Germany and France and the northern European countries dictating to the Mediterranean-based European countries that you get your act together, your
Yeah.
economies are in shambles, how, you've got to do whatever you have to do, all sorts of austerity measures. And now it's the other way around. Spain, Italy, and Greece seem to be the strong bottom of the EU, while the northern countries are the ones suffering.
Oh, the
You know,
irony. Oh, the irony. Well,
I'm
look,
just waiting to hear the Greek finance minister tell Germany, get your act together, get your house in order.
I'm laughing, but I mean, Brexit, mate. Anyway, look, I've got to jump. It's been great. It's been nice. So next week we're recording. I know it's August lull. What would it be? 31st of July next week. Should we go then?
Yeah, I think we'll put another one out up for the August holiday commences. So we'll definitely do that, and then we'll have about another 2 week break in August, and then come back probably around August 15, 16, if all things be willing.
Okay. Okay. Well,
All
look,
right.
crew.
Well, thank you all for listening to another episode of The Smoking Barrel. Catch us on Spotify, LinkedIn, and YouTube. And we look forward to seeing you again next week.
Ciao.